Hi everyone. Thank you for attending today's webinar. I appreciate you taking the time to discuss a topic most people know is important, but often put off. Today we're talking about protecting your family's income, not in a complicated or salesy way. We're going to keep it simple and practical. When people hear life insurance, they often expect the conversation to be uncomfortable or full of confusing terms. My goal is the opposite. I want you to feel like this is a normal conversation about your income and how it affects the people you care about. My name is Jay Cohen, and I'm a licensed agent for Gibbs Insurance and Financial Services located in Ocala, Florida. We sell health and life insurance and annuities. And today, I'm going to walk you through a simple way to think about life insurance as income protection. You don't need to know about policy language or exactly how much cover you need, and you definitely do not need to make a decision today. All you need to think about is this: who depends on your income, and what would you want to make easier for them if you were not here to provide it? That means keeping the home stable, like helping with childcare or giving a spouse time to adjust. It can also be making sure final expenses and debts do not become an immediate burden. This presentation is educational. Every family is different, and the right answer depends on your situation, your budget, your health, and what you already have in place. So today is about clarity. By the end, you should have a better sense of what questions to ask and what a review would actually look like. Let's start with where financial pressure tends to show up first. And please, do not feel like you have to solve the whole thing while we are talking. If you leave with 2 or 3 good questions, that is useful. If you leave realizing I should check what I already have, that's useful too. This is the first step in the conversation. We are taking a topic that can feel heavy, and we are making it manageable. When families think about income, they usually do not think of one big annual number. They think in real life categories: home, kids, food, cars, bills, debt, and savings. That is why this slide starts with pressure points. The first pressure point is the home. For many families, the house payment, which could be a mortgage or rent, is the biggest monthly commitment. If something happened, the question is not always, could the family keep the house forever? The first question may be, could they stay put long enough to make a calm decision? This is a very different question. Having time matters. A surviving spouse or partner may eventually decide to sell, downsize, move closer to family, or make another change altogether. But ideally, that decision is made because it was the right decision, not because the next payment is coming due and there are no other options. The second pressure point is kids and care. If children are still in the home, life may get more complicated, not less. There may be daycare, after-school care, summer programs, activities, tutoring, or just the extra support needed when one parent is suddenly caring more. Care can also mean helping an aging parent, supporting a spouse with health concerns, or paying for help around the house. Every family looks different. The third pressure point is monthly bills. These are ordinary expenses that are easily overlooked because they are so familiar. They are groceries, utilities, gas, car payments, insurance premiums, phone bills, prescriptions, and school supplies. Nothing glamorous, but it all matters. Sometimes the stress does not come from one giant bill. It comes from normal life continuing when income is changed. The fourth pressure point is debt and final costs. This may include credit cards, car loans, medical bills, personal loans, or funeral expenses. Some debts feel manageable when income is steady, but they can become heavy very quickly if a household loses income. The fifth pressure point is breathing room. This is one thing I think people underestimate. Breathing room means your family has time to regroup, time to make phone calls, time to talk with family, time to get organized, time to make decisions without feeling cornered. That does not remove the emotional loss, of course. Nothing does. But it can reduce the financial panic that often comes with it. So, for this slide, I would ask you to think about your own household for just a moment. If one income stopped, where would that pressure show up first? Would it be the house payment, childcare, debt, monthly bills? Would it help a spouse or partner avoid rush decisions? There is no right or wrong answer. The point is to identify the pressure points before choosing a solution. Once those are clear, the rest of the conversation gets easier. Here's a quick way to use this slide after today. Pick the category that would create the most pressure first. Do not pick all five, just pick one first. For one family, that may be the home payment. For another, it may be childcare. For another, it may be debt. For someone near retirement, it may be making sure a spouse has choices. That first pressure point tells you where the planning conversation should begin. It keeps the review from becoming too broad or too abstract. It also helps you avoid comparing your situation to someone else's. Your neighbor's need may not be your need. Your coworker's coverage amount may not make sense for your family. So, the first job is simply to identify where your family would feel the strain. Once we know that, we can start asking better questions. Next, let's look at what your paycheck is already doing every month. This slide is about giving your paycheck a job description. Most of us do not think of income that way, but your paycheck is already assigned to different jobs before you even think about it. Part of it goes to the home. Part of it goes to food. Part of it goes to cars, insurance, medical expenses, children, savings, debt, and future plans. The paycheck is doing quiet work in the background. So instead of starting with the question, how much insurance should I buy? It helps to start with, what is my income responsible for? One job is keeping the home stable. That may include mortgage or rent payments, taxes, repairs, utilities, or simply the ability to keep family routines in place for a while. For many families, the home is not just a line item. It is where the family feels grounded. It is where the school routines start, where dinner and holidays take place, and where everyone ends up at the end of the day. Another job is care. That could mean child care, elder care, support for a family member with special needs, or extra help if one person suddenly has to handle more of the household. This matters because care needs can increase after a loss. Some may need more help with children or time away from work. Some may need paid support to keep the household functioning. Another job is everyday life. Groceries, gas, car repairs, doctor visits, prescriptions, insurance premiums, school supplies. These expenses do not always feel dramatic, but they are constant. And constant expenses can become stressful fast when you lose an income. Your income also supports future choices like saving for college or keeping retirement plans on track. Maybe it means preserving emergency savings or helping a child with school, training, or a first step into adult life. Those future goals are often the first things family pause when money gets tight. Sometimes that's unavoidable. But if those goals matter to you, they should be part of the conversation. Then there is one more job income does. It creates options. Options are valuable. Options mean the family can decide what to do next rather than being forced onto one path. For example, a surviving spouse may not immediately know whether to stay in the home, change jobs, move closer to family, or adjust childcare arrangements. Income protection can create time for those decisions. Here's an example. In a two-income household, one paycheck may cover the mortgage and utilities, while the other paycheck covers groceries, childcare, car payments, and savings. The household works because both paychecks have jobs. If one paycheck disappears, the family does not just lose a number. They've lost part of the plan that paycheck was carrying. That is also important for single parents, business owners, caregivers, and couples where one income supports shared goals. So, the key question on this slide is simple. What jobs would you want your income to keep paying for if you were not there? That answer helps shape the coverage conversation. One helpful exercise is to look at 1 month of expenses and sort them into 3 groups. The first group is must keep going. That is usually housing, food, utilities, transportation, insurance, and basic care. The second group is important if possible. That might be activities, savings, educational goals, or help for the family. The third group is could pause for a while. These are things that matter but could adjust during difficult transitions. That little exercise can be eye-opening because it should show you what your income is truly carrying. And it makes the life insurance conversation more grounded. We're not trying to insure every choice forever. We are trying to protect the part of life that matters most. Now that we know what part income supports, let's talk about when the money may be needed. This slide is about timing. One mistake people make is thinking of life insurance as a single lump sum with no real structure, but in real life, your financial needs show up at different times. The first stage is immediate. These are the costs that can show up almost immediately. Final expenses, emergency cash, the first round of bills, travel, time away from work, or getting help for the first few weeks. In the early stage, people usually don't think like financial planners. They are making arrangements, calling family, handling paperwork, and trying to keep daily life moving. Having money available can take one source of stress off the table. The next stage is the first year. This is when the household begins to adjust to a new reality. The home still needs to be paid for, food, utilities still matter, debt payments keep coming in, and child care and work schedules may need to change. Transportation still has to work. The first year is often like heading down a runway. The family may not need every question answered immediately. They may just need enough time and support to make thoughtful decisions. Then there are the years ahead. If children are young, support may be needed for many years. If there's a mortgage, the family may want help maintaining the home stability. And if educational goals matter, those need to be considered. If a spouse is close to retirement, the planning may look different. This is why there is no universal coverage number. You may hear shortcuts like 10 times your income. That can be a starting point, but it's not the full answer. A better approach is to look at the timeline. What would you need to be handled right away? What support would you need during the first year? What longer-term goals would you still want protected? Once you separate these pieces, the conversation becomes much less overwhelming. Start by thinking about what needs to be protected: funeral costs, the home, the kids, any debts, and make sure your spouse has time and financial stability and flexibility to figure out what comes next. That is much more useful than guessing at a random number. Some questions to think about are: what would my family need immediately? What monthly support would help during the first year? What debts would I want handled? What future goals matter enough to protect? What coverage or savings do I already have? If I have coverage through work, would it stay with me if my job changed? You do not need perfect answers. Rough answers are enough to begin. The goal is not to make the topic complicated. The goal is to organize it. Once the timing is clear, we can look at what type of coverage may fit. Let me put this into a simple example. A family may want final expenses handled right away. That is one need. They may want the mortgage supported for several years. That's a second need. They may want child care covered until children are older. That's a third need. Those needs all may need to be part of one plan, but they are not all the same. They happen on different timelines. That is why timing matters. It helps us decide whether the main need is short-term cash, several years of income support, long-term protection, or a combination of these. Timing also helps with the budget. If the biggest need is temporary, a temporary solution may make sense. If the need is lifelong, then the conversation may be different. This is where a review becomes useful. We can align the need, timeline, and budget instead of guessing. This also helps prevent two common mistakes. One mistake is buying too little because the number feels random and you want to keep the premium low. The other mistake is assuming you need an enormous number without looking first at what you really already have, what you need, and for how long. A thoughtful review sits in the middle. It looks at the need, the existing resources, and the budget. Another way to think about this is that each stage answers a different question. Right away asks, what has to be handled now? The first year asks, what would help if the household stays steady while everyone adjusts? The years ahead asks, what future choices would I still want my family to have? Those are the three different questions. Keeping them separate makes the planning feel less overwhelming. Now we can talk about policy types. I'm going to keep this high level because you don't need to become an insurance expert to make a good decision. The idea is this: different types of insurance serve different purposes. Term life insurance is used during the years when the need is biggest. That might be the case when children are young, when a mortgage is still large, or when the household depends heavily on earned income. Term coverage lasts for a period of time, like 10, 20, or even 30 years, depending on what's available and appropriate. For many families, term life can be a practical way to get meaningful coverage during a specific season of life. Think of it like protecting the high responsibility years, the years when children are home, the years when the mortgage matters most, the years when a spouse or partner would need time to adjust. Permanent life insurance is different. It is designed to provide lifelong coverage as long as the policy remains in force and the policy requirements are met. Some permanent policies may also build cash value. That can make sense for people who want long-term protection, legacy planning, or coverage that is not tied to a temporary need. Permanent coverage is not automatically better than term. Term is not automatically better than permanent. They are simply different tools. Then there is workplace coverage. A lot of people have some life insurance through work, and that could be a good thing, but it is worth checking the details. How much is it? Is it equal to 1 year's salary, or is it equal to 2? Is it portable if you leave the job? Would it be enough for your family? Or is it just a helpful starting point? Workplace coverage can be useful, but many families should not assume it is the whole plan without reviewing it. So when somebody asks, what kind is best? The answer is usually best for what? If the job is protecting young children for their school years, term may be a good fit. If the job is lifelong protection or legacy planning, permanent coverage may be part of the conversation. If the job is to fill a gap between workplace coverage, we compare what you have with what your family may need. The right policy is not just one with the biggest number. It has to fit the need, fit the budget, and be something you can realistically keep in place. And just as a reminder, policy features, costs, and availability vary from carrier, state, underwriting, and policy terms. So we do not need to guess. We can look at your situation and compare options. One thing I want to emphasize here is that the policy type is not a personality test. It is not about whether you're a term person or a permanent person. It's about the job. If you need to protect income while children are young, that's one job. If you want coverage that could stay in place for life, that's another job. If you already have some workplace coverage and just want to know whether it's enough, that's another job. And sometimes the answer is a combination. A person may have workplace coverage, add term coverage for the mortgage and children raising years, and later consider permanent coverage for a different purpose. Or they may want to keep it simple with a single policy that meets the main need. The review is where those options get compared. Budget matters too. A policy looks great on paper, but is uncomfortable to keep is not a good fit. Life insurance only helps if it remains in force when needed. So when you look at coverage, I want it to pass 3 tests. Does it fit the need? Does it fit the budget? And does the person understand what they are buying? If those 3 things are true, the decision usually feels much clearer. This is also why I do not like starting with product names. Product names come later. First, we identify the job. Then we look at which tool may fit that job. That keeps conversation practical. For example, if the concern is a 20-year mortgage, we may consider one solution. If the concern is leaving something behind, regardless of when the death occurs, we may look at something else. If the concern is supplemental employer benefits, that is another conversation. Same topic, different job. Next, let's walk through a simple worksheet that will help start that conversation. This worksheet is meant to make the conversation easier. It's not about finding the perfect number in 5 minutes. It's about getting main pieces on the table. The first item is income support. How long would your family need help replacing your income? If children are young, the answer may be longer. If the children are grown, it may be shorter. If a spouse depends on your income, that matters too. The second item is mortgage or rent. Would you want your house to be paid off? Would you want your payments covered for a period of time? Or would you simply want your family to have enough time to make a thoughtful decision? The third item is kid and care. The children are still in the home. What support would they need? Daycare, after-school care, activities, college goals, or other family needs may be part of the picture. If you're caring for an aging parent or another family member, that belongs here too. The fourth item is debt and final costs. What would you want handled quickly? Credit cards, car loans, medical bills, funeral costs, and personal loans. These are all the kinds of expenses that can add pressure at a difficult time. The fifth item is what already exists. Do you have savings, workplace coverage, an existing life insurance policy, investments, or other resources? Those resources matter because they reduce the gap. Then we get to the protection gap. That is the difference between what your family may need and what is already available. This is where people sometimes get nervous because they think they need exact numbers. You don't. Rough numbers are fine for the first conversation. You can estimate. You can round. You can say, I'm not sure, but I think it's around this, and that's completely okay. The purpose of this worksheet is to move forward from vague concern to a clearer starting point. Instead of saying, I have no idea what I need, you start saying, here are the things I care about. Here is what I already have, and here is what I should probably review. That is progress. This also helps avoid overbuying or underbuying. If you do not know the need, you are guessing. If you walk through the need, the conversation becomes more grounded. So, if you use this worksheet later, do not worry about making it perfect. Just fill in what you can. The rest can be worked on through the review process. Here is how this might sound in real life. Someone might say, I want my spouse to have help for 5 years. I do not necessarily need the house paid off, but I want the mortgage covered long enough for them to decide what to do. I want the car loan handled, and I want enough set aside for final expenses. That is not a perfect financial plan yet, but it is a very useful starting point. Then we look at what already exists. Maybe there are savings. Maybe there's workplace coverage. Maybe there's an old policy. Maybe there are investments or other resources. Those resources reduce the gap. The worksheet also helps couples talk. Sometimes one person assumes the other would want one thing, but they never actually said it out loud. That gives you a simple way to start that discussion. And if you're single, it still helps. You may have children, parents, siblings, business obligations, or final expenses you want handled. The worksheet still applies. This process helps ensure you don't purchase too much or too little coverage. Without understanding the actual need, you're simply estimating. By taking the time to identify the need, the conversation becomes more meaningful and recommendations more accurate. One thing I like about this worksheet is that it gives people permission to be approximate. You do not need to say the exact number is this. You can say the mortgage is roughly this. Child care is roughly this. And I think we have about this much coverage through work. That is enough to begin. From there, we can refine the numbers together. The first pass is just getting the major pieces out of your head and onto paper. Now, let me show you what the review looks like. A review does not have to be complicated. It is really just a practical conversation. Step 1 is to talk it through. Who depends on your income? What would you want protected? What are the biggest bills or responsibilities in the household? Step 2 is the estimate. We look at income, debts, final costs, existing savings, current coverage, and any major goals you want to protect. Step 3 is to compare. We look at the coverage types, possible amounts, and what may fit your budget. And I want to emphasize the budget, because the right policy is not just the biggest one. It has to be something that makes sense and something you can keep in place. Step 4 is to choose the next step. Sometimes the next step is applying for coverage. Sometimes it's just adjusting what you already have, and sometimes it's gathering more information. Sometimes it's, let's revisit this later. Any of those can be a good outcome if you leave with more clarity than you had before. If you want to prepare, bring rough numbers like income range, mortgage or rent, major debts, child's ages, current coverage, and general budget comfort zone. You do not need to have everything figured out before this conversation. That is what the conversation is for. A review is also a good time to check details that are easy to forget. Who are your beneficiaries? How much workplace coverage do you actually have? Does it stay with you if you leave the job? Do you have an older policy that should be reviewed? Sometimes the best outcome of a review is not immediately buying something new. Sometimes it's organizing what is already there, finding one gap, or confirming that you are in better shape than you thought. I'd like to think of it as a checkup, not a test, not a sales appointment, just a checkup. You leave knowing what you have, what you may need, and what the next steps could be. And if the next step is simply think about it and come back later, that's fine too. Clarity is still progress. Life changes, children are born, mortgages change, jobs change, marriages change, health changes, budgets change. So even if you're looked at this before, it's worth checking again. During the review, I also want people to feel comfortable saying, I don't know. That is a perfectly fine answer. If you're not sure how much workplace coverage you have, we can look at it. If you're not sure whether an old policy is still active, you can check. If you do not know what the budget range feels like, we can walk through those options. The review is not about having the perfect information before you begin. It's about getting organized enough to make a good decision. And the decision does not have to happen all at once. Sometimes people need to go home, talk with a spouse, check a benefit statement, or think about the budget. That is totally normal. Let's close with next steps. Before we end, we have a few minutes to go over questions I was sent. The first one is, what is the biggest misunderstanding people have about life insurance? A lot of people think it's only about funeral costs. That can be part of it. But for families, it's often more about replacing income and keeping life steady. Is workplace life insurance enough? It may be a good start, but it's worth checking. The amount may be limited, and it may not stay with you if you change jobs. How do I know how much coverage I need? Start with income, housing, debts, kids or family needs, final costs, savings, and any coverage you already have. Next question, is term or permanent life insurance better? That depends on the job the policy needs to do. Term often fits temporary high-need years. Permanent may fit long-term protection and legacy goals. What if I'm not sure I can afford coverage? That's exactly why a review helps. We can look at the options, budget ranges before making a decision. So that wraps up this presentation. If the presentation made you think, I should probably take a look at this, that's a good next step. Remember, you do not need to know how much coverage you need. You do not need to know whether term or permanent life insurance is right. You do not need to know every number. The easiest next step is to schedule a no-pressure life insurance review. We can look at your family, what you already have, and what you want to protect, and which options may fit your goals and budget. You can reach me. Again, my name is Jay Cohen, and you can reach me at 352-661-7858. Or you can email me at that's Jay, at gibbsinsuranceocala.com. Or visit my webpage at www.gibbsinsuranceocala.com. Again, this is educational. Coverage, availability, features, costs vary by carrier, state, underwriting, and policy terms. This is not tax, legal, or investment advice. Thank you for spending this time with me. Protecting family income is really about protecting choices, stability, and the people who count on you. I would be happy to help you take the next steps when you are ready. If you are unsure whether a review is worth doing, that is exactly a good reason to have one. You may find out you're in better shape than you thought. You may find a gap you did not realize was there, or You may simply get your questions answered and have a clear sense of direction. There's no pressure in that conversation. The goal is to help you understand options. So when you are ready, reach out. We can talk in simple language and take it to the next step, one at a time. One last thought before we wrap up. This is one of those planning topics where doing something small can feel like a big relief. You do not have to solve everything today. You do not have to know every answer. You just have to be willing to take the next step. For some people, the next step is to check workplace coverage. For others, it's reviewing an old policy. For others, it's sitting down for the first time and figuring out what the family would actually need. Whatever your next step is, it is worth taking. And if you're listening to this and thinking, I'm not sure where to begin with a conversation. That is enough. We can sort through the details together in simple language and make the next step manageable. Thank you very much and have a great day.